Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 2 of 14. Mr. Market, your emotionally unstable business partner, from The Intelligent Investor, the definitive book on value investing by Benjamin Graham. Commentary by Jason Zweig.
And we are really getting into the core of it today.
What if the stock market isn't smarter than you? It's just louder.
Man, that is the ultimate question, isn't it? I mean, it's honestly the question that separates people who actually build wealth from people who just get completely stressed out.
Right.
It distinguishes those who build generational wealth from people who just kind of churn their own money until it disappears into fees and taxes and terrible timing.
I really love that framing. And look, we are diving into what is arguably the most famous metaphor in the entire history of finance.
Oh, absolutely.
Like if you've spent even 5 minutes on a value investing forum, or if you've read a Warren Buffett letter or just watched financial news for a week, you have probably heard some reference to Mr. Market.
Yeah, you hear it all the time.
But I think a lot of people treat it like a cute little story, you know?
A bedtime story.
Exactly like a bedtime story for investors. And then they just move right back to looking at their charts.
Right, they think it's just an anecdote. They think, oh, that's a nice little illustration. And then they go right back to staring at the ticker tape.
Letting the flashing colors dictate everything.
Yeah, letting the red and green numbers completely dictate their mood for the day. They treat the metaphor as a novelty rather than what it's supposed to be, which is a fundamental operating system for your financial life.
Exactly. But in this deep dive, we are going to treat it like what it actually is. It's a survival mechanism.
It really is.
This isn't just a story. It is a psychological vaccine. It's the mental model that allows you to survive the inevitable crashes and manias that will definitely happen in your lifetime.
Multiple times in your lifetime.
Multiple times, yeah. So to kick this off, I want to run a little visualization experiment. I want you listening right now, whether you're on a treadmill or driving to work or sitting at your desk, I want you to really play along with this.
Let's do it. It always helps to make it concrete. We really need to move this from the abstract concept of the quote-unquote stock market to something tangible.
Okay, so imagine you own a private business. Let's say it's a hardware store.
A classic local hardware store.
Right. A solid local business. You sell hammers and nails, lumber, maybe some garden supplies. Or, if you want to be more modern, let's say it's a small software startup. A SaaS company that makes a really specific piece of software for accountants.
Something boring but profitable.
Exactly. And you own a share of this business. Let's say your stake cost you $1,000. It's meaningful money to you, but it's your entry point. And you have a partner in this business.
A silent partner.
Not silent. No, anything but silent. This partner's name is Mr. Market. And unlike a normal business partner who might, look at your inventory or check the spreadsheets or ask about profit margins.
Normal rational business thing.
Yeah, rational things. This guy is, he's emotionally unstable.
To put it mildly, in clinical terms, Graham describes him, and keep in mind, this is a diagnosis from the 1940s, but he calls him manic-depressive.
Which is pretty intense for a finance book.
It is. Today, we might say he has severe bipolar disorder mixed with a massive gambling addiction and perhaps a touch of narcolepsy. He is just not a well man.
Right. So here's the scenario. Every single day, rain or shine, Mr. Market shows up at your front door or at your office. He bangs on the door. You open it, and he tells you what he thinks your $1,000 share is worth right now in that exact moment.
And he offers to either buy you out entirely or sell you more of his own shares.
And this is where it gets weird, right? Because his offers have absolutely nothing to do with how many hammers you sold yesterday or how many software subscriptions you renewed.
Zero connection to reality, none. Some days, Mr. Market shows up and he is just euphoric. He's seeing rainbows. He thinks the hardware business is the literal future of humanity.
He sees infinite growth.
Infinite growth, exactly. He thinks people are going to start building houses on Mars, and they will absolutely need your specific hammers to do it.
Yeah.
And he yells, I'll give you $2,000 for your share right now. Double your money.
Even though the business hasn't changed at all since yesterday.
The inventory is exactly the same. The customers are the same. The cash register holds the exact same amount of money. But his mood has shifted, so the price shifts.
Exactly. But then other days, Maybe it's raining, or he woke up on the wrong side of the bed, or he read some scary headline in the paper about a war in a country he can't even find on a map. He shows up looking absolutely terrified.
Just completely despondent.
He thinks the world is ending. He thinks nobody is ever going to buy a hammer again. He thinks civilization is collapsing. And he says, this place is worthless. I'll sell you my share for $500. Just get me out of here. Please take it.
And then the very next day, he's back to euphoria. Or maybe he's just bored and quotes you exactly what he did the day before.
Back and forth every single day. Now, here's the real provocation for everyone listening to this deep dive right now. If you had a real-life business partner who acted like this.
Someone who actually swung from mania to depression every 24 hours?
Right, who let his unchecked emotions dictate his valuation of your life's work, would you trust his judgment?
Of course not. You would probably try to get him professional help.
You definitely wouldn't let him dictate your net worth. You wouldn't wake up in the morning, see him crying on your doorstep and think, oh no, my business must be failing because he's sad today.
No, you'd think he's just having a bad day.
You wouldn't feel smarter just because he was in a good mood either, or feel like a failure just because he was depressed. You'd probably look at him with a mix of pity and annoyance.
You'd offer him a cup of tea and gently send him on his way.
But that is exactly what we do with the stock market.
It is. We let this wildly manic-depressive character tell us how to feel about our own financial security.
And this is the core insight of Chapter 8 of the book. Graham argues that most investors treat the market as an oracle. They think the price on the screen is some kind of verdict from on high.
Right. If the price goes up, the oracle is telling them, good job, you're smart, this business is succeeding. If the price goes down, the oracle is saying, you messed up, this business is failing, get out right now.
It's literally looking for validation from a crazy person.
Yeah.
It's like asking a toddler to grade your doctoral thesis. Why do we do that?
Precisely. And Graham wants to completely invert that power dynamic. He says the market is not a judge. It is a servant. Its only job is to provide you with price quotes.
It's there to serve you, not to guide you.
Yes, it is a utility, like the electric company or the water company, except instead of water, it supplies the liquidity.
I really want to drill down on that servant, not master idea because it sounds really good on paper. It makes for a fantastic social media quote. But in actual practice, it is incredibly hard to live by.
Well, it's agonizing.
Because when you see your portfolio drop 20% in a single month, which absolutely happens, it does not feel like a servant offering you a bargain. It feels like a master punishing you for making a terrible mistake. It feels visceral in your stomach.
And that's because we are social animals. We are biologically wired to look for consensus. If everyone else is selling, which is what drives the price down, our mammal brains just start screaming that the herd must know something we don't.
But there's a lion in the bushes that we just can't see yet.
Exactly. That's why Graham calls this an allegory. It's a cognitive tool to distance yourself emotionally.
Yeah.
You have to visualize the market not as the market, capital T, capital M, this omniscient, powerful entity, but as this specific, flawed, slightly pathetic character.
It's all about stripping the market of its authority.
Yes. When you personalize it as Mr. Market, you realize, oh, he's just freaking out again. It allows you to step back and look at the actual numbers. It lets you engage your prefrontal cortex, the logical part of your brain, instead of your amygdala, which is your fear center.
So let's unpack the rule of engagement with this character, because Graham is very specific about the investor's supreme advantage. Institutional investors often don't even have this, but you, the individual listener, you do.
The advantage is the freedom to say no. Just think about it. If you are a mutual fund manager or a hedge fund manager, you have clients, you have quarterly reports you have to file.
You have bosses.
Right. If the market tanks and your clients get scared, they pull their money out. You have to sell stock to pay them back right at the exact moment prices are lowest. You are a forced seller. You literally do not have a choice.
You're a hostage to your client's emotions. You're effectively leveraging your entire career on the mood swings of strangers.
Exactly. Yeah. But as an individual investor managing your own capital, you are never obligated to transact with Mr. Market. His quotes are an offer, not a command. There is no law anywhere that says you have to trade today.
You can just listen to his price laugh in his face, slam the door, and wait for tomorrow.
Or next week. Or next year. You have the ultimate luxury of time.
And there is a specific quote from the chapter that I think just nails this perfectly. It's one of those sentences you should probably tattoo on your arm if you're prone to panic selling.
Let's hear it.
Graham writes basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal.
And I want everyone to notice the word opportunity in that quote. Not obligation, not signal, opportunity. It frames volatility as a tool you use, not a storm you just have to suffer through.
And then comes the truly radical part. The part that Wall Street absolutely hates because they can't charge you fees on it. The part that brokers do not want you to know.
The do-nothing option.
Right. Graham continues in the book at all other times. He will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies.
That do-nothing option is the hardest thing to execute in finance. It's the idea that for 99% of your investing life, your best move is to simply ignore the guy banging on your door. Just let him yell. Let him tire himself out on the porch.
It sounds kind of like Zen Buddhism applied to capitalism.
It really is in a way. It's the art of strategic inaction. Most people think investing is about doing things constantly. Buying, selling, analyzing, trading, reacting to news. Graham is saying that investing is actually mostly about waiting.
Waiting for Mr. Market to do something truly stupid.
Exactly. And until then, just minding your own business.
But Graham doesn't just leave us with a theory here. He brings receipts. He was a data guy, an analyst at heart. And this is where the history gets so fascinating. He tells the story of the Great Atlantic and Pacific Tea Company, A&P.
A&P is such a perfect example because for modern listeners, it might sound like an old-timey relic. But you have to realize A&P was the Amazon or Walmart of its day.
It was huge.
It was the dominant retailer in America. It wasn't some fly-by-night speculative tech stock. It wasn't a meme stock. It was a solid, massive blue-chip empire. It had stores on every corner. It completely defined the American grocery experience.
So set the scene for us here. It's 1929, the roaring 20s, jazz flappers, and a stock market that seemingly only ever goes up.
Right, it's the absolute peak of the bubble. Mr. Market is in a state of sheer euphoria. He looks at A&P, this massive grocery chain, and he says this is worth $494 a share.
$494, okay, that's the high watermark. Everyone holding it feels incredibly rich.
Then the crash hits. October 1929, Black Tuesday. The Great Depression begins. Unemployment soars to 25%. Breadlines form. The Dust Bowl. The whole 9 yards of economic misery.
And Mr. Market spirals.
He spirals into a deep clinical depression. By 1932, just 3 years later, that exact same Mr. Market is quoting A&P at $36.
From 494 down to 36, that is a 92% drop.
A near total wipeout of value. Now put yourself in the shoes of an investor in 1932. If you treated the market as an oracle, what would you assume happened to the actual business?
I mean, with a 92% drop, you'd assume A&P was bankrupt. You'd assume the stores were literally burning down. The management had embezzled the funds and fled the country, and nobody was buying groceries anymore. You'd think the company was dead.
You'd think the stock certificate was basically just expensive wallpaper at that point.
But here is the reality check. And this is what Graham just loves to point out. During that exact same period, 1929 to 1932 A&P's actual underlying business was arguably getting stronger.
Stronger.
Wait, really? In the middle of the Great Depression? How is that even possible?
Yes, their cash reserves actually grew. Their earnings remained incredibly stable. Why? Because they were the low-cost provider. In a severe depression, people stopped buying luxury cars, they stopped going on expensive vacations, but they still need to eat.
And they need to eat cheaply.
Exactly. So A&P was actually capturing market share from competitors. They were the solution to the exact problem the economy was facing.
So the business itself was completely fine. The partner had just gone insane.
Exactly right. The intrinsic value of the business, its ability to generate cash and serve customers, was holding steady or even improving.
Yeah.
But the price had totally collapsed.
If you listened to the price, you saw ruin.
But if you looked at the business, the operating results, the dividends, the balance sheet, you saw the bargain of a lifetime.
The investor who bought at 36 wasn't taking a massive risk. They were basically buying a dollar bill for 7 cents simply because the guy selling it was having a panic attack.
And that right there is the pure definition of value investing, exploiting the gap between price and value. It's arbitrage. But instead of arbitraging currency differences, you are arbitraging human emotion.
It's amazing how clear it looks in the rearview mirror, right? 1932, of course, you buy A&P. But let's fast forward, because I think people today have a tendency to say, well, that was the Depression. Markets were primitive back then. We didn't have the internet. Markets are sophisticated now.
Oh, people say that all the time. They say markets are perfectly efficient now. We have complex algorithms. We have global data networks operating at the speed of light. Mistakes like that just don't happen anymore. They really think technology somehow cured human nature.
So let's talk about Inktomi. This is from Jason Zweig's commentary in the book. He brings Graham's lesson right into the dot-com era to prove that human nature hasn't changed.
Inktomi Corp. This was a classic infrastructure play of the early internet. They made search engine technology. And this wasn't some silly pet food delivery website. This was real hard tech. They powered the search functions for Hotbot, for MSN. They were the backbone of early search.
So it's March 2000, the absolute peak of the dot-com bubble. The NASDAQ is skyrocketing. Everyone is quitting their day jobs to day trade tech stocks.
Mr. Market is in his euphoric phase once again. He looks at Inktomi and he says, I value this company at $25 billion. That's billion with a B.
And was Inktomi making billions in profit to justify that?
Inktomi wasn't making a single dime. They were actively losing money. They had never made a profit in their existence. But the narrative at the time was pure, untethered potential.
Mr. Market was screaming the internet is the future, profits don't matter, eyeballs matter, just buy at any price.
It was the new economy where the old rules of math supposedly just didn't apply anymore.
So 25 billion. Fast forward just 2 short years, December 2002. The bubble has burst. The massive hangover has set in.
Mr. Market is severely depressed again, and he ends up selling Inktomi to Yahoo. Do you know the exact price per share?
I know it's bad, but hit me with the number.
$1.65.
From a valuation of $25 billion
To a valuation that was basically pocket change. The stock price collapsed from huge highs, over $200 a share at the peak, to less than the cost of a cup of coffee.
So we have a multi-billion-dollar error in judgment by the so-called wisdom of the crowd.
And just like with ANP, you have to ask yourself, did the actual intrinsic value of that search technology change that drastically in just 2 years? Did the code suddenly stop working?
No, the mood changed.
Exactly.
Yeah.
The narrative shifted from growth at any cost to show me the actual profits right now. Mr. Market realized he had wildly overpaid, and in his embarrassment and sheer panic, he swung all the way to the other extreme and essentially just gave the company away.
It really highlights the absurdity of the numbers. If you walked into a car dealership today and the dealer said this Honda Civic is $500,000, you'd laugh in his face. You know generally what a Honda Civic is worth. You have a solid reference point.
Right.
But with stocks, because the price is flashing constantly on a screen and because it's Wall Street telling us, we just assume the price must be right.
That is the hidden danger of liquidity. Because you can sell a stock instantly, you start obsessing over what you could sell it for at any given second.
It drives you crazy.
It really does. Think about it, if you owned a physical house and a crazy neighbor shouted a lowball offer from his driveway every single morning, you'd ignore him. You'd say, I'm living here, go away.
Right.
But because the stock market shouts offers every second, and because it's so incredibly easy to just click sell on an app, we listen. We let the liquidity, which is supposed to be a massive benefit, become a psychological curse.
And that brings us directly to today, 2026. Because if Mr. Market was loud in 1949 and he was louder in 2000 today, he is absolutely deafening.
He isn't just knocking on your door once a day when the newspaper arrives anymore. He isn't just on the evening news. He is living in your pocket.
Yeah.
He's vibrating on your wrist in your smartwatch. He's in your smart glasses.
Let's talk about that amplifier effect, because Graham definitely couldn't have predicted push notifications. He couldn't have predicted Robinhood or crypto exchanges that are open 24/7, 365 days a year.
No, definitely not. In Graham's day, you had to physically look at a newspaper to get closing prices. Or maybe you called your broker on a rotary landline. There was built-in friction, and friction is actually good.
It forces you to pause.
Friction gives you time to think. It gives you time to let your emotions cool down. Today, you have zero commission trading apps. You have instant price alerts. You have Reddit threads. You have X. Mr. Market is buzzing your size 17 times an hour.
Apple is up 2%. Tesla is down 5%. Your portfolio is down $400 today. Bitcoin just crashed. It is completely relentless.
Exactly. It has created this constant dopamine loop. When the price goes up, you get a hit of dopamine. You feel smart. You feel rich. You feel like an absolute genius. When it goes down, you get flooded with cortisol fear, stress, feeling incredibly stupid.
You are chemically tethered to the mood swings of a bipolar system.
You are literally outsourcing your internal emotional regulation to a random number generator.
And we saw this play out perfectly with the meme stock phenomenon just a few years back. I mean, look at GameStop or AMC. That was Mr. Market on absolute steroids.
Textbook Mr. Market behavior. You had struggling retailers, businesses that were objectively having a really hard time closing physical stores, losing massive amounts of money, being priced at tens of billions of dollars one week and then cratering the next.
And the really scary part there was the social reinforcement aspect. You go on Reddit and it's not just a number flashing on a screen. It's an entire movement. It's millions of people yelling, bye, 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 diamond hands, hold the line.
That is the modern megaphone.
Yeah.
Mr. Market used to be one solitary guy knocking on your door. Now he is an entire digital mob. And the feedback loop has compressed from taking days or months to taking literally seconds.
It's terrifying how fast it moves now.
In 1929, the crash took years to fully bottom out. In the meme stock era, you could lose 50% of your entire net worth in a lunch break while you were eating a sandwich.
Yeah.
The volatility has become totally weaponized.
So the psychological danger for the average person is higher now than ever before.
Much, much higher.
Yeah.
Because the temptation to treat the price as a daily scorecard for your own intelligence is constantly right in your face. The lesson Graham teaches, to firmly detach your self-worth from the ticker, is arguably the single most important skill for a modern investor.
You really have to be able to look at a blood red screen and just say, that's Mr. Market's problem, not mine.
That's his problem, not mine.
I love that. It's about setting boundaries, financial and emotional boundaries. But on this deep dive, we have to talk about the limitation here. Because I feel like there's a trap, a real danger in taking this metaphor too far without understanding the nuance.
There is a huge trap here. It's the trap of denial.
Right. Because if I just sit there and say, oh, the market is crazy, I'm ignoring the price drop, I might be actively ignoring a real fire. I might be the dog in that internet meme sitting in a burning room saying this is fine while everything burns down.
Exactly. You can only ignore Mr. Market if, and this is a massive, bold, italicized, underlined if, you actually know what your underlying business is worth. If you don't know the intrinsic value, you have absolutely no right to ignore the price.
Oof, that is a tough love moment for a lot of people.
It has to be. Ignoring the market without doing your own rigorous valuation analysis isn't discipline. It's just stubbornness, it's denial, it's intellectual laziness. You can't just plug your ears, hum loudly, and hope for the best. You have to actually do the work.
Let's talk about the value trap, because this is where people lose their shirts thinking they're being clever contrarians.
This is the nightmare scenario for a value investor. Mr. Market drops the price of a stock by 50%. You say, Mr. Market is manic-depressive. He's just irrationally scared. I'm buying more. I'm being just like Warren Buffett.
But the business is actually failing.
Right. Sometimes the price is down because the business is genuinely dying. Maybe there is massive accounting fraud. Maybe their core product just became completely obsolete. Maybe they are drowning in debt and heading straight for bankruptcy.
It's like confidently buying shares of a horse and buggy company right as the first Model T is rolling off the assembly line. Or buying Blockbuster video stock when Netflix started streaming.
Exactly. Or Enron, right before the massive collapse. The price was dropping rapidly. If you just applied the Mr. Market is crazy logic blindly, you would have bought it all the way down to zero. You would have lost absolutely everything.
So the market isn't always wrong. Sometimes the fear is completely rational.
Sometimes the market is screaming fire because there is actually a massive fire in the building. And as an investor, you need to know the difference between real smoke and just a false alarm.
And this isn't just hypothetical theory. Graham himself, the guy who literally wrote the book, The Absolute Master.
Yeah.
He has some real scars here. He wasn't immune to getting this wrong.
He definitely does. And the book sometimes glosses over this a bit, but we should be completely honest about it here. We need to humanize the guru. In the 1929 crash, Graham got absolutely hammered.
How bad was it really?
He entered 1929 with significant leverage. He was using margin debt. He ended up losing about 70% of his fund's value, from the peak to the eventual trough.
70%. That is a career-ending number for most professionals today.
Yes, it was devastating. His wife actually had to go back to work as a dance teacher just to pay their daily bills. I want you to really think about that. The creator of the margin of safety concept, the father of value investing himself, struggled to distinguish between a manic market and a genuine catastrophic economic collapse. He thought stocks were incredibly cheap in 1930 and he bought more, and then they got cheaper. He thought they were an absolute steal in 1931, and they got even cheaper still.
That is incredibly humanizing. It really makes you realize that even for the certified genius, the fog of war is very real in the moment. It's easy for us to sit here today, look back at A&P in 1932 and say, oh, obvious buy. But Graham was actively living through it, and he was bleeding money.
It is sobering, and it perfectly reinforces the core lesson you need an anchor. That anchor is your own independent, deeply researched estimate of intrinsic value. If you don't have that, if you haven't painstakingly looked at the balance sheet, the earnings history, the competitive position, then you are just drifting aimlessly.
You're not investing, you're just gambling on a rebound.
You're hoping Mr. Market magically changes his mood tomorrow rather than actually knowing what the underlying business produces in cash.
So to summarize the limitation perfectly, Mr. Market is a highly useful metaphor for psychological defense, but it is absolutely not an excuse to turn off your brain.
Perfectly said. It actively protects you from panic, but it doesn't protect you from buying a terrible business. It helps you manage your raw emotions, but it doesn't replace the hard requirement for math.
Now I want to pivot to the debate angle of this deep dive, because there's a whole massive school of thought in academic finance, the heavyweights, the Nobel Prize winners, who think this entire Mr. Market concept is just folksy nonsense.
Yes, the efficient market hypothesis, the EMH. It's essentially the dominant religion of modern academic finance.
Right, Eugene Fama and the modern finance theory crowd. Their central argument is essentially Mr. Market doesn't actually exist. The current price is the exact value.
Yes, the argument goes exactly like this. The market is made up of millions of highly intelligent, wildly ambitious, incredibly well-funded people. They all have instant access to the exact same information. They have massive supercomputers.
So if a stock is objectively too low, they would instantly buy it, driving the price right back up.
Exactly, and if it's too high, they would short sell it, driving it right back down.
Yeah.
Therefore, at any given microsecond, the price perfectly reflects all available wisdom in the universe. The price is always 100% right.
So under that theory, if the price drops 10% in a single hour, it's not because people are irrationally scared. It's because the collective computational wisdom of the world decided the company is objectively worth 10% less right now.
Correct. Under the strict EMH view, there are absolutely no mood swings. There is only new factual information being processed instantly by the hive mind.
Which implies that ignoring the price is actually actively ignoring reality. It implies that if you sit there and think a stock is cheap, you are just totally deluding yourself.
It implies you are incredibly arrogant. It implies you honestly think you somehow know more than the combined collective intelligence of the entire planet.
So how does Graham counter this? Because he clearly doesn't believe it. He built his entire legendary career on the fundamental idea that the price is very often totally wrong.
Graham's counter is actually very nuanced. And I think this is so important for people to understand. He actually agrees that the market is highly efficient most of the time.
Really? He admits that.
Oh, yes. He says that on a typical boring Tuesday for a typical large company, say a Microsoft or a Coca-Cola, the current price is probably a very reasonable estimate of its true value. Mr. Market is usually pretty rational. He's usually taking his medication and doing his job. But he is not always perfectly efficient. Graham argues that the market is highly efficient at processing raw data, but it is absolutely terrible at processing human emotion.
That makes total sense.
When extreme fear or extreme greed completely take over, the pricing mechanism just breaks. When millions of people are panicked, they don't care about the spreadsheet anymore. They just desperately want to sell. They want the psychological pain to stop. That creates a massive dislocation.
So the true investor's edge isn't about being smarter than the collective market every single day. It's not about trying to outsmart algorithmic supercomputers on a random Tuesday afternoon. It's about patiently waiting for those specific rare moments where the machine completely breaks down.
Exactly. The real edge is found in the extremes. You generally don't make outsized money betting against the market when things are boring and normal. You make life-changing money when the market is either screaming in euphoria or crying in terror. You make your money in 2008 and 2020.
It's kind of like playing poker. You just fold most of your hands, you sit there quietly and do nothing. You wait patiently for the exact moment when the other guy is on tilt, when he's overly emotional, angry, and making terrible bets.
That is a fantastic analogy. The efficient market hypothesis essentially assumes nobody ever goes on tilt. It assumes every single participant is a perfectly rational, emotionless robot. Graham, on the other hand, assumes human nature never fundamentally changes, and people will always inevitably go on tilt.
And when they do, they create incredible opportunities for the disciplined investor who kept their head.
Exactly right.
So the ultimate question for you, the listener, the real philosophical fork in the road here, is do you truly believe the market is a perfect, emotionless calculator of value? Or do you believe it's actually a wildly swinging barometer of human emotion?
Because your personal answer to that exact question dictates your entire financial strategy. If you think it's a perfect calculator, just buy a broad index fund, never look at it again, and go to sleep. But if you think it's an emotion barometer, then you have to actively watch for the massive storms. You have to be fully prepared to act decisively when the barometer goes completely crazy.
Which leads us perfectly to the takeaway. We have talked about all the deep theory, the historical stories, the academic debate. But it's Monday morning, the market is officially open, I'm looking at my phone, I see flashing red numbers everywhere. What do I actually do with this knowledge? How do I apply the Mr. Market concept to my real life today?
We definitely need a concrete action step here, something you can literally do right now. I like to call this the price versus value separation exercise.
Okay, walk us through it step by step.
Open your brokerage portfolio right now. Look at your specific holdings. Do not look at the total gain or loss column. Ignore the red and green. Just look at the list of companies or funds you own. For every single holding on that list, I want you to ask yourself one very serious question. If the stock market completely closed tomorrow for 5 solid years, no daily quotes, no trading, no liquidity whatsoever, would I be genuinely happy owning this specific business?
5 entire years, no price checks, no way to hit the sell button.
None. You are entirely stuck with it. You are legally married to it for half a decade. You will receive whatever dividends they pay out, and you will get the annual reports showing the actual operating results. You'll know if they sold more software or more hammers. But you absolutely cannot see a daily stock price, and you cannot sell a single share.
That thought alone is probably terrifying for a lot of people, especially if they own highly volatile speculative stuff.
And if it's terrifying, that tells you something incredibly important immediately. It tells you that you are only holding that specific asset because you are hoping to sell it to a greater fool next week at a slightly higher price. You aren't actually investing in the underlying business. You're merely speculating on the short-term price action.
It completely forces you to look at the business reality, just like that smart A&P investor in 1932, rather than obsessing over the momentary price reality.
Exactly. If you own a genuinely good business, let's say you own a share of a highly profitable, steadily growing company with great management, you honestly don't care if the market closes for 5 years.
You know they're fine.
Right? They will just keep selling products, making solid profits, and sending you dividend checks in the mail. You sleep perfectly fine at night. But if you own a hyper-speculative meme stock that actively loses money every single quarter and the market suddenly closes, you realize very quickly that you own absolutely nothing but a worthless piece of digital paper.
It shifts your entire mindset from keeping score every day to actually owning productive assets.
And making that specific mental shift is the only real way to finally silence Mr. Market. When you permanently stop using the daily price as a scorecard of your own intelligence, you regain your ultimate freedom. You just stop caring what the crazy neighbor shouts from his driveway.
There is a final quote from Chapter 8 that I think really brings this all home beautifully. It perfectly sums up the entire investment philosophy. Graham writes the investor's chief problem, and even his worst enemy is likely to be himself.
That is the whole ballgame right there. The actual goal of all this isn't to somehow beat the market. The real goal is to fully master your own internal psychology. Mr. Market is honestly just a giant projection of our own deep-seated fears and unchecked greed. He's just a mirror reflecting humanity.
Wow.
If you can rigorously control yourself, if you can somehow stay completely calm when that mirror is showing you a terrifying monster, you can fundamentally control the game.
That is just an incredibly powerful place to land today. We are not actually fighting the ticker tape. We are fighting our own biological instincts. We are fighting our own hardwired urge to blindly follow the panicked herd.
And winning that specific internal fight is absolutely the most profitable thing you will ever do in your life. It's the only real way to actually win at investing.
I absolutely love it. Now, before we fully wrap up today, I want to leave the listener with one final provocative thought to chew on, something we didn't explicitly touch on, but is definitely lurking in the background of this whole modern discussion.
Go for it. Let's hear it.
So we talked all about Mr. Market as a partner, right? A flawed human-like character. But in the modern age of AI, high-frequency algorithmic trading, and massive quantitative funds, is Mr. Market even human anymore?
That's deep.
I mean, 80% of daily trades are executed by soulless machines in literal microseconds. Does the old manic-depressive human analogy still perfectly hold? Or are we now dealing with an entirely new kind of volatility, a cold, calculated, lightning-fast volatility that doesn't actually care at all about human fear or greed, but just cares about mathematical liquidity flows?
That is an endlessly fascinating question. Are the deep learning algorithms mimicking our emotions? Or do they simply amplify our existing emotions to profit off them? Or perhaps by removing the human element entirely, do they actually make the market substantially more dangerous because there is no human judgment left to hit the emergency brakes when things go crazy?
It's definitely something to chew on this week. Maybe Mr. Market is slowly turning into robo-market. That was lesson 2 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.